Good morning. It's winter, stage 2 load shedding, and level 2 lockdown. Feels a lot like last year. Fortunately, the markets are a lot better than they were last year, so it's a little bit less stressful. But the deja vu is hard to shake. A couple of different things we're going to look at today. We're going to look at the SPIVA scorecard, and spend a lot of time looking at some of the individual funds. FAANG Fund, Health Innovation Fund, Income Maximiser Fund, and just talk to you about them and why it's a good time to invest in some of those portfolios. So jumping straight in. The SPIVA South Africa scorecard, this is for the year ending 2020, is the percentage of South African funds outperformed by benchmarks. So if you look at the 1-year number, it looks pretty okay. 1/5 of active managers beats the benchmark locally. If you look at the global, which is the second line here, 1/3 of South African asset managers beat the global benchmark. So 1/5 and 1/3, not too bad. If you go out to 5 years, that's when the numbers look pretty scary. Only 6% of active managers or funds beat their local benchmark, and the same, 6% beat their global benchmark. So there are a lot of nuances about this scorecard. It's not perfect. I could have an entire webinar just talking about the pros and cons of this in the active passive debate. I have done many webinars and panels on active versus passive, and there really isn't a debate. There isn't. We've got to a point where you have to have passive in your portfolio. It all depends on how much passive you want. And that depends on your risk appetite. In Sygnia, we offer funds with as little as 20% passive and as much as 100% passive. So you can choose depending on your risk appetite and whether you do want to take on the active risk or not. And active managers certainly are more expensive, and you take on active risk. Passive is lower cost, and there's no active risk. But it doesn't mean that we don't believe in active managers. It's just that we think that you need passive in your portfolios in a low return environment to keep the costs down and to ensure that your portfolios are working well. So I believe there's a technical issue. Which screen are you seeing? Sorry about that. I'm not quite sure why it wasn't sharing. So let's just have a look at those quick numbers again. As I mentioned, looking at the SPIVA scorecard, 1-year basis, 1/5, 20% of active managers beating the benchmark. Locally, globally, it's 1/3, and over the 5-year number, 6% is what we're looking at. And as I said, it's not a debate. Whether you have a little bit of passive or a lot of passive depends on your risk appetite, but you do need to have passive to keep your costs down in a low return environment and to manage your risk allocations. We prefer to take more risk globally where there are more opportunities and have less risk, and more passive locally where there are less opportunities. And unfortunately, those opportunities are shrinking by the day. JSE is half the size it used to be in terms of number of shares a decade ago, and South Africa's weight in the MSCI index is also down to a fraction of what it used to be, to a point where foreigners don't even bother looking at our inclusion of South African shares. At 2 or 3%, it's just not worth the effort of researching our market. They might pick 1 or 2 shares, but it's certainly, we're a rounding error on the global stage these days. So we have funds that offer 100% passive and funds that offer as little as 20% passive. And I'm going to talk about our Synergy range because we launched that yesterday in the retail space. The funds have been around for 3 years in institutional space, but we launched them yesterday into the retail space. Not a unit trust, but on the life license, so either RAs or LAs or direct investors through endowments can invest in this range. So it's the lowest amount of passive, 20 to 30%, and invest in domestic balanced mandates. So what that means is that for the offshore portion, Sygnia manages it passively with our global themes, but on the local side, we invest in the balanced domestic mandates of the big managers. Alan Gray, 91, Stanlib, these are the top 10 from the Alexander Forbes Global Large Manager Survey up to 2021. So while we do believe in active management, we also believe it's very difficult to pick managers that are consistently good top performers. And this chart here just shows you the amount of volatility that exists. So this is a ranking of the various managers over the last 14 years. You can see here, starting 2008, Alan Gray, top of the pops. 2009, they're nearly the bottom. 2010, they are at the bottom. 2011, back at the top. You can see here, each color represents a manager. Some managers no longer exist, but generally, even the ones that have been very persistently good, they pop around all over the place. So one take home from that is you do need to blend, and certainly in the Synergy range, we do blend. We blend 4 or 5 active managers on the domestic side. But the other thing is to just acknowledge the amount of risk that you have to take. So Warren Buffett says, if you're not an expert, rather be passive. And this is from the world's leading active manager. He said, if you're not an expert, rather be passive. And we certainly feel the same way. If you look back at the SPIVA scorecard, your best case scenario on a 1-year basis, you've got managers, your 1/5 to 1/3 of managers are beating the benchmark. So you really do need to make sure that you are picking the right managers. You've got better 1/5 or 1/3, 20% or 30% odds. You've got much better odds at a casino. But if you have got the time and you have got expertise, you can find managers that consistently beat the benchmark, and that's what we do in the Synergy range. And the performance of the fund has been very good. We pick the top 4 or 5 managers, and we have been beating the average. But the headwinds are against you. When it comes to active managers, if you have to invest in every active manager, you're basically getting the market less their trading costs. And assuming that they're turning their portfolio over once a year, those trading costs can be up to 1%. So it's not that they haven't got skill, but your starting point is -1. This is before we talk with fees. This is just brokerage and tax and other market slippage. So you need to add 1% value just to get to your starting point. So it's a tough game. I suppose that's the bottom line. It's a tough game. There are some managers that consistently do it well, but it's incredibly difficult to pick those. So despite the SPIVA scorecard and showing you how difficult or how few managers to beat the benchmark, we do have a range of funds that has 70 to 80% active in South Africa. And if you do prefer the active management and you have got an appetite for high active risk, then that's certainly something that you can look into. But getting into economics about those fund ranges. Here we have the richest man in the world, fellow South African father of 6, Elon Musk. And he put a spanner in the Bitcoin works this month, saying that the energy usage trend over the past few months is insane. And it has been insane. He's certainly not wrong about that. But at the same time, people who live in glass houses shouldn't be throwing stones or whatever that saying is. And we're going to look at the Tesla ESG scorecard just to have a quick insight to how well Tesla's doing on that front. So looking first at the energy usage, you can see here in the top right-hand chart, Bitcoin, the light red bar there, using more energy than Sweden and Ukraine and Argentina, nearly as much energy per year as South Africa. And I don't know about you, but I'd much rather that power could come to South Africa so we didn't have load shedding rather than get used to calculate Bitcoin transactions. But anyway, it is what it is. It's a large amount of energy. And certainly I think that coins such as Ethereum, which rely on proof of stake, as opposed to Bitcoin, which relies on proof of work, probably have a better survival chance going forward because they are less energy intensive. Then the bottom right-hand table looks at Tesla's ESG score. So this is the S&P 500, and it looks at the eligible companies in the automobiles and components industry. So you can see there, number one from an ESG rank is General Motors with a great score out of 100 of 95. Fourth is Ford with a score of 36. And last is Tesla with a score of 22. So it just brings, again, the question, most of the ESG indices out there are looking at electric vehicles as a key component of going green, and investing in Tesla as the best electric vehicle company out there. But their ESG score is terrible. And there is certainly, as I mentioned before, a question of whether electric vehicles are green in terms of A, at the moment they're using a lot of dirty power, and B, they have batteries which are lithium-ion batteries are terrible for the environment and cannot be recycled. And again, to get back, just briefly to get back onto my soapbox about this, there are two things that you can be guaranteed of, and unfortunately, it's not good news. The one is we from an economic environment, we're basically in purgatory. Over the next probably 30 years, we're going to have lower returns than we have in the past. And that means if you're young, you're going to have to save more for retirement than your parents had to save, because you're going to get much lower income from your retirement portfolio. And two, if you're close to retirement, you're going to have to probably retire later than you wanted to, and save more, because again, you're going to be getting less from your portfolio. Hard truth. The second hard truth is about ESG. If you change your 100-watt light bulb to a 5-watt light bulb, that is fantastic. You're consuming less. If you change from a 100-watt to a 5-watt and you then put 20 light bulbs in your garden, you're not consuming less. Similarly, if you trade in your 2-liter 100-kilowatt car and get a 300-kilowatt Tesla, you're using 3 times as much power. Yes, maybe it's battery power, and maybe you're even charging from a solar grid, but you're not consuming less. ESG, certainly climate change, is about changing our way of consumption. Consuming less, maybe using public transport instead of using your 2-liter car every day. That's a way of consuming less. Using 5-watt light bulb instead of a 100-watt light bulb. Consuming less. But ESG has been hijacked by marketing companies, where you get told if you can spend more and consume more because it's now green, but it's not. And your greenest power is solar and wind farms, but they're very erratic in terms of their power production. So they require huge battery plants, massive factories of batteries, which it's nearly as bad as having to look after plutonium, because you can't recycle them. So bottom line, ESG, it's not sexy, and it's not about finding clever ways. It's actually about, unfortunately, the hard truth is we need to recycle, we need to consume less, we need to find clever ways of doing it. And it's not like Europe wants to do banning all petrol cars. Maybe you should just try and encourage public transport. But anyway, off my soapbox quickly, back to ESG in China and the US. So Elon Musk suspended Bitcoin, and a lot of people jumped on the bandwagon very quickly. Greenpeace, I mean, they're not a big user of Bitcoin, but they no longer accept donations. We then had Iran and Turkey both quickly say that they are not accepting Bitcoin transactions anymore. Chinese central bank reiterated that they will not allow Bitcoins to be used for transactions. In fact, the Chinese vice premier said it's necessary to crack down on not only Bitcoin usage, but Bitcoin mining and trading. The US, similarly, US Treasury announced that the crypto transfers above $10,000 must be reported to the Internal Revenue Services, and anyone who disregards that has to only think of Al Capone. You don't want to mess with the IRS in the US. Once the IRS is involved, you're going to face some serious headwinds. And locally, SARS has also been clamping down, and they've recently forced the 3 local crypto exchanges to give them all the information: who's holding what, where they trade. So governments are after the tax. And the US went further to say that cryptocurrency poses a significant problem by facilitating illegal activity. That's from the US Treasury. So they're worried about money laundering, they're worried about tax. And I think that with the Fed now looking to launch its own cryptocurrency and other central banks following suit, you're going to find that that's more likely we're going to be forced into those avenues. Anyway, so Bitcoin fell 50% on all this negative news. It went from a peak of 64,000 in April, 64,000 down to touched 30,000 in May. More than half, lost more than half of its value. And markets came off at the same time, mostly because of sentiment. But what is an interesting fact, I'm not sure if everyone is aware, but you hold Bitcoin in your retirement portfolio. Naspers, which is the biggest company on the exchange, South African exchange, holds Prosus. Prosus holds Tencent. Tencent holds Tesla, and Tesla owns Bitcoin. They have sold a little bit, but they still own their Bitcoin. So it is interesting that you know, it's a very small global village, and we all have a bit of Bitcoin in our retirement portfolios, thanks to Naspers. And Naspers and Prosus came out with a big announcement this month. Prosus wants to acquire nearly half of Naspers' shares, in exchange give Naspers shareholders Prosus shares. So basically, if you're holding 20% Naspers, you're going to end up with roughly 10% Naspers and 10% Prosus. And what's going to happen is that it has a big impact on the indices. So the SWIX index will see its Naspers weight fall from 22 to 12, and that's roughly halving, while the Prosus weight is going to close to triple, going from 2 to 6%. So there are two important impacts from this. The one is that, unfortunately, your exposure to the Tencent group falls from 24% to 16% in the SWIX, which is sad because it is, you know, it is an exposure to the fastest growing sector in China, which is the fastest growing country. So it is nice to have the diversification. The second thing is that the SWIX will only have 2% more exposure to the combined Tencent group than the cap SWIX. So the indices start to look almost identical, and maybe there won't be a need for the cap SWIX going forward. And why go through that unnecessary trading cost each quarter if you can get virtually the same thing with the SWIX index? So some big moves when we're looking at the markets, and some impacts on our portfolios in terms of the sentiment that drove down Naspers this month. Naspers was hit hard on the back of tech concerns, and did have a little bit of Bitcoin. So the other big market move, and generally markets have been, from an economic perspective, been quite quiet in May. And there's only a bit of noise coming out of the US and China. So looking at the US, we have here Richard Clarida, the vice chair of the Fed. And he's talking about inflation. He says, only transitory effects on underlying inflation. And that's very, very, very important to you and to me and to the whole world. And it's summed up in this chart here. So what you can see from the chart, the white line is the increase in US inflation expectations. Obviously, as the markets are opening up and as lockdown losers become lockdown winners, that inflation number is picking up. What's happening is that because the Fed is looking through inflation and they're calling it transitory, they're not going to raise rates. That means that your real yields, which is the purple line, come down. Now, real yields are the most important driver of exchange rates. And as a result, you can see here how the blue line, which is the US dollar, has moved in tandem. So a weakening real yield in the US, because the Fed is looking through inflation, is allowing a weak dollar. A weak dollar is very, very, very good for the rest of the world. Keeps the dollar funding costs low, which is very good for commodities, very good for trade, very good for emerging markets, and generally rest of world growth. So it is one of the reasons why we continue to be optimistic on 2021 as a whole, because we do think the dollar is going to stay weak for quite some time. So why does the Fed believe that inflation is transitory? And we certainly agree with that. Well, we think that we're not going to see another 70s style inflation spike. So the 70s inflation spike peaked, in fact, in the early 1980s, April 1980, at 14.7%. That's a huge number, and it was a terrible stagflationary environment. And 1982 in May was the highest CPI number since the number we've just seen. So So yes, US inflation is at a 40-year high and getting close to those 70s style numbers. But we're facing a very, very different outlook. Firstly, growth is much higher than it was in the 70s. Secondly, our starting point for interest rates, for inflation, is much lower than it was in the 70s. Thirdly, we're looking at where that inflation is coming through. It's not coming through from wages, which is the most important driver of a sticky inflation. And it's even not coming from the cyclically sensitive inflationary sectors. So the normal components of your economy that tend to pick up when inflation is picking up. It's actually been limited to the reopening sectors. So that's something that looks transitory. And then in addition, we're not seeing huge spikes in oil. The oil supply shock was one of the big drivers that we saw in the 1970s. Yes, oil has recovered somewhat, but there's a lot of supply that can come online. And we've got the new normal where people are traveling less. Certainly a lot less tourism and a lot more work from home. So that the demand is a lot lower and the supply can easily increase. So given that, we're quite comfortable that although inflation is going to rise this year, and US bonds will rise this year, and the dollar will stay weak this year, we don't think that inflation is going to be sticky, and we don't think it's going to force the Fed to raise rates too soon. So it looks like the Fed's going to raise rates early 2023, and that's what markets are anticipating. I think that's a likely scenario. Yes, any mention of an earlier hike could see a taper tantrum like we had before. So we are watching these numbers very closely, but our base case scenario is that we're going to have a transitory inflation, the Fed being very dovish, allowing the dollar to stay weak, which is good for us. The other big news this month came out of China, and there they're talking about focusing on resource prices. So China's central bank came to say companies must not fabricate or spread price increase information to disrupt market order. And there were a lot of other parts, regulatory bodies that came out as well. They said the government said they'll show zero tolerance for monopolies in spot and future markets and zero tolerance for speculation and hoarding. They also banned retail trading. So, as a South African, you can buy an oil future on our market. That's been banned in China. And there's also a chance that they mentioned they may release their strategic commodity stockpiles, which would increase supply and lower commodity prices. They're also talking once again about climate change and trying to clean up their industry, which again will reduce the demand for some commodities. But overall, their hawkishness on commodity prices means that we are likely to see some headwinds to commodity prices coming, or at least some stabilization in commodity prices over the second half of this year. And we've already seen it come through quite strongly in May. Resource sector was down locally in South Africa, and a lot of commodity prices did dip on a lot of this news. And it's not only that, but the chart on the right here talks to China's credit impulse. So that's one of the leading indicators of Chinese growth. So that the solid line here is from BCA, shows you your China credit and fiscal impulse, the leading indicator, and the dotted line is the commodity index. And you can see here, commodity index has peaked at huge levels we haven't seen since the late 2000s, when we had a global resource boom. And that was after many years of a resource boom. So we're back to those scary levels, but the leading indicator has definitely turned and is looking downward. So between China's negative rhetoric on commodities and certainly the slowdown in the credit impulse, which leads their commodity imports, I certainly think that China's old economy is going to slow, and commodities are going to see some headwinds, further headwinds. China's new economy, on the other hand, we don't expect to slow. What's happening is the Chinese government is trying to rebalance their economy from the old economy to the new economy, which is focusing on tech and focusing on domestic consumption. And that's why we are investing in the Chinese new economies sectors in our funds. So we remain overweight emerging markets. We remain overweight China, but we are concerned about the rand. We are overweight global because we do think the rand is looking expensive, below 14, and certainly with commodity prices coming off, the rand could see some headwinds over the next 6 months. Lastly, before we look onto our positioning and some outlooks onto the funds, it's always have to talk about locally. And once again, it's preceded by a deep sigh on my side. Here we have President Ramaphosa talking about the ACE debacle. Says, as long as we fail to act against corruption, we will struggle to restore the credibility of the ANC. Certainly, they are failing to act against corruption, trying very hard, but failing to get any meaningful reforms put through. And Tito Mboweni highlighted the next, unfortunately, critical aspect that we're going to see some bad news come out of locally, and that's municipalities. He's frustrated that he's had to take over the running of some municipalities because they are so poorly looked after. And he says, we can't speak of economic recovery when municipalities find themselves in perpetual crisis. And that's very true. When municipalities are running huge debts, when they're collecting 18 cents on the rand in terms of debt collection, when water and electrical services aren't being provided, roads are crumbling, we need action. So once again, everyone's calling for the right things. Everyone knows what needs to happen, but we're struggling to see that. And most of all, we're struggling to see that in terms of our stable energy production. And that's key to growth in South Africa, as I keep saying. And once again, we find ourselves in stage 2 load shedding. And the chart here on the right is the energy availability factor in 2010. Here you can see there it was around 84%. This is 11 years ago. We've been in load shedding for 13 years. So the government, even if they had failed to plan and they were caught surprised by load shedding in 2008, they've had 13 years to put together a plan and implement a plan to get ourselves through load shedding. So let's look at the scorecard. Well, the scorecard is the energy availability factor, which is this chart here. And you can see here that in 2010, despite being 2 years into load shedding, we had about 85% of our production online. And we've now hit an all-time low of 60.5% for the first half of 2021. Nearly half of Eskom is offline. And we wonder why we're having load shedding. So this, just again, we're aware of what needs to happen, but implementation is in this case shocking. After 13 years, we've got a lot less energy available as a percentage of our production than we should have, and that's what we're seeing now during load shedding. More and more reactors are offline for unexpected reasons, not for planned maintenance, and it's leading to load shedding. And what's terrible is at the same time, you've got the NPA trying to freeze 1.4 billion rands worth of assets for former Eskom executives who I presume have plundered. And we've got continued allegations around the 255 billion rand Turkish-made power ship contracts. And at the same time, we've got Gwede Mantashe coming out and refusing to raise the threshold for embedded generation products. So we've got companies in South Africa who could very easily start putting electricity back into the grid. President Cyril Ramaphosa at the State of the Nation address said that he believes we should raise the cap from 1 megawatt to 50 megawatts. And Gwede Mantashe is saying that's not the case. He's saying that Cyril didn't say that. And he said that if we do raise the cap to 50, that it's going to lead to chaos. So he's fighting, the easiest thing to do, which is just to remove some red tape and allow some self-generation. So it's just disappointing and frustrating. COVID as well, yes, certainly things have improved. We find ourselves, unfortunately, in lockdown level 2, but we did start phase 2 of South Africa's vaccination program on the 17th of May, and we're nearly at 1 million people who have 1 million administered doses. And we have another 1 million doses that are in the country, far short of the 50 million that we need, but we've got another 1 million there. So hopefully we can start accelerating that. Right now, we're way below the 100,000 per day that we need to get to the to have 2/3 of our population vaccinated by the end of the year, that hopefully things will improve, and that will help our economy, because the biggest impact is not, well, it's not just lockdown. And certainly lockdowns impact and shut down the economy, but it's also tourism. South Africa, we rely heavily on tourism for sources of revenue, and when you've got a local population that hasn't been vaccinated, then foreigners do not want to come to South Africa. So it's about creating comfort for tourists. It's about rolling out those vaccines, and it's about opening up our borders. And right now we're on every watch list, probably unfairly, I think, but we're on every red list and watch list and banned from traveling. And then, as a quid pro quo, our government bans those countries, and you end up with no tourists going anywhere because we've got a supposedly dangerous variant. So once again, we remain underweight South African equities because growth is just not there. Now we've got the Eskom and Covid headwinds. We remain overweight South African bonds because there is close to the highest real yields in the world, and we think that those are attractive, and it's linked to the strong rand, which and commodity boom, which certainly is going to give us a really good budget numbers when they do come up, and we will certainly have a surplus relative to what was expected, which will help our bond market. So that brings us to the overall positioning slide. So you've all seen this slide many times. It's our core satellite view, investing in a low growth environment. We believe in a strong, large, passive core, which is diversified, low cost, investing in liquid market cap weighted indices. So the SWIX index locally, or the MSCI World globally, or the S&P 1200 ESG global index make up a big portion of that. And when it comes to broad indices, we're underweight South African equities, we're overweight South African bonds, overweight global equity, and underweight global bonds. We don't have any global bonds because we believe that gold, global bonds, and Bitcoin are all closely correlated and are impacted by quantitative easing. And then we have our satellites. So we've got bond alternatives, where we look for we don't want to hold global bonds, but try and find something that is a better proxy. So there we've got our global property specialist real estate fund. We've got disruptive technologies, which is our FAANG fund, and our Fourth Industrial Revolution fund. We've got emerging Asia, which is our emerging markets 50 ETF, and our China New Economies Unit Trust, which is currently sitting with FSCA. We should hopefully launch in a few months. We've got our Health Innovations satellite, and that looks at OSI and our Health Innovations Unit Trust. And we soon will have an ETF in that space. And then we've got infrastructure locally, which looks at credit, and certainly a nicely diversified portfolio to equities, and while still being a real return asset class in some instances. So where do we sit on these various portfolios? Well, we are overweight our global property, our specialist real estate, because we don't hold any global bonds. So we see that as a nice alternative. I'm going to be talking about FAANG and why we think that it's now, we have been buying some FAANG. It's our first nibble. We sold FAANG nearly a year ago, more than a year ago, because we were worried about the valuations, and we rotated into Fourth Industrial Revolution. We sold out of Fourth Industrial Revolution in January this year, and in February, and we now think it's time to get back into FAANG. Emerging Asia, we remain very overweight that sector. China and EM, we think that's got the structural tailwinds of the emerging middle class within Asia, ex-Japan. The health innovations, we are overweight. We remain maximum overweight, and I'll talk more about why we still believe this is a good time to top up that exposure. And on the infrastructure basis, we made our first investment into our local infrastructure bond. We're very excited about that. It was delayed by a month while National Treasury sorted out definitions. And that's generally what we are seeing, is that there's a lot of projects that need to have, that are ideal to invest in for infrastructure within South Africa. There are a lot of funds who are very keen to support that, but there's a delay, once again, in implementation while we sort out nomenclature and Reg 28 definitions, and unfortunately, there's a bottleneck. But hopefully, we're starting to see signs that that bottleneck is thinning out, and we will be able to invest in further investments there. So let's look at some of those satellite portfolios in more details. So firstly, value versus growth. As I mentioned, it's not one of our satellites. Value is not a satellite, as we do think it's something you don't want to invest in for the long term. But there are times where you can take advantage of it. So generally, our backdrop is next decade, low growth, low return environment. And in that environment, you want to invest in companies or areas where you are seeing growth. So even though the world as a whole is going to face low growth, you find satellites that do have high growth. So emerging Asia, disruptive tech, healthcare, those all are sources of growth, which will do well and outperform in that environment. But in 2021, we're seeing reflation. We're seeing lockdown losers become lockdown winners become lockdown winners. We're seeing economies open up, and we're seeing value do well. And we do think that value will continue to do well. So we have topped up our value position further. It's now a larger allocation in our global portfolio for a number of reasons. The top right-hand chart shows in blue, that's the relative earnings of growth versus value. You can see here that the value earnings are starting to accelerate relative to growth earnings. And this is supporting the white line, which is the relative price movements. So you can see there how value got hurt a lot more than their earnings would suggest, but that is turning the corner, and value's outperformance will be supported by that change in earnings. Similarly, the bottom right-hand chart from Goldman's just shows how the light gray line at the bottom is value. Value has lagged far more in the current recession than it has in other recessions, and has got further room to catch up. Then the other reasons that we've already been long value tends to do well when interest rates are rising because it's got more near-term cash flows. And if you look back at the last 50 years, whenever inflation in the US has peaked as it has now in April, with a very strong core CPI number, well, in those environments, US tech tends to not do as well. That said, it doesn't mean it's not a bad time to get into FAANG. You might think, well, that's odd because FAANG is tech. FAANG is not tech, actually. We've got a lot of the companies in the FAANG index are not in the technology sector. They're in the consumer sector or the services sector, and they found themselves as disruptive technologies and platform companies in a broad range of the S&P 500. The other advantage that FAANG has got is that the companies are relatively mature, still growing, but relatively mature compared to some of the disruptors, with actually pretty decent cash flows. So your cash flow yields on the FAANG companies are around 3%. And that's not something that you expect from a company that with such strong growth. And there certainly is going to be differentiation over the rest of the year. When interest rates are rising and when there's more focus on cash flows, the growth companies with stronger cash flows are going to do better than the growth companies with weaker cash flows. And we are going to see the FAANG companies do well relatively because of their strong cash flow generation. So this brings us to the other two charts here. You can see the top right hand just shows FAANG 24-month PE relative to the S&P 500, and we're now sitting, this is looking back over nearly 7 years, FAANG at the cheapest it's been relative to the S&P in a long time. So what we have been doing is we've been buying some FAANG, funding it from S&P 500, from the US. And likewise, when we topped up value, we funded it from selling the US. And the US is our biggest underweight globally. In fact, it's our only underweight globally, and it's used to fund all our exposures in terms of our satellites. Bottom right-hand chart shows the real earnings yield on the S&P 500. And you can see here, this is going back 40 years. S&P is at its most expensive from a PE perspective, or this is earnings yield, in 40 years. So it's another reason why we're comfortable to start making this switch. The S&P is looking expensive, FAANG is looking less expensive than the S&P. It's still giving you some US exposure, but it's looking at those companies that have growth while also producing strong cash flows. And we think that it's good. Certainly, we're not taking a large overweight. We're nibbling. We're buying our first tranche into FAANG. We are expecting volatility in tech in general and growth in general over the rest of the year. But we do think now is the time to start nibbling back into the FAANG portfolios, or topping up if you do have some capacity to do so. Then health innovation. Health innovation is looking incredibly good right now. Bottom right-hand chart shows, so the dotted green line is long. So sorry, this is a relative chart that shows healthcare versus the broad market. Over the last 10 years, you can see how healthcare continues to outperform the broad market. But over the last 18 months, it has underperformed. So what happened with COVID? You can see that the COVID shock early 2020, healthcare shot the lights out, and it's slowly been unwinding some of that premium to the point where it looks like a good place to get back in relative to the broad market. Certainly, it's supported by earnings. Again, top right-hand chart, you can see Johnson & Johnson Q1 2021 earnings up strongly. Pfizer earnings up 45%. AstraZeneca earnings up 167%. Moderna going from a loss to a profit. So the earnings are starting to feed through from the COVID-19 vaccines. We're also seeing very strong research coming out supporting the vaccines. McKinsey says that we're likely to need another 29 billion vaccines by the end of 2023. That's just a staggering number. We're also seeing improved efficacy from studies, and more importantly, and this is what I get excited about, is the indirect benefits. So we've had billions and billions of dollars that have been spent on R&D for COVID-19. And one of the big winners is messenger RNA or mRNA. So the way that we're fighting COVID vaccine is completely new and novel way, and it's very exciting. It uses messenger RNA, but it's not limited to COVID. Well, first of all, it can be used to attack a wide variety of viruses, and it's already shown to have some success in HIV, but it can also be used to treat cancer and a variety of other diseases. So all of a sudden, there's a new toolkit that can be unleashed on a host of existing diseases, and that's going to lead to a whole new set of firstly well-being and improved health for people, but at the same time also increased revenue generators for the healthcare companies. And long term, we still believe in the structural tailwinds of the healthcare sector, driven by aging populations and improving living standards. When you have older, wealthier people, and you've got new technologies bringing out new medications, it's just supply and demand. Both are increasing, and it's the structurally a great place to be over the next decade. So we are maximum overweight healthcare in our global satellites, we think now is again a great time to be topping up and at least definitely holding on to that. And we think it's a great part of your portfolio. And we certainly understand, and then there has been some investor concerns, and we look at the bottom right-hand chart, you can see there that the healthcare has underperformed the relative market. Healthcare has underperformed the relative market, unfortunately, and it hasn't done as well as we're hoping. But we do think, we're investing for the long term, and we do think that things are going to turn and get better going forward. The last fund I want to talk about is the Income Maximiser portfolio. So this is only available on our life license, so living annuities, endowments, retirement annuities. We don't have unit trust for it. But I also want to position it against our other fund range because it is quite confusing. The space is a confusing space, and certainly if you look at other income funds and even our own income fund, the nomenclature that is used is very misleading. So this chart shows on the horizontal axis is risk, some sort of volatility risk measure, and then yield on the vertical axis. So the yields here are current yields. They're no indication of what the past was or what the future was. It's just what the yield was. This is a week old. But a week ago, the annualized yield at the time for our money market unit trust was 4.1%. Still way better than your bank accounts. I think bank accounts are giving you about 3% if you're lucky on your overnight accounts. Yes, you can put it in term deposits, but term deposits lock you in, whereas a money market unit trust doesn't lock you in. So 3% in your bank account, 4% in the money market fund. We've got about 6.7% in our income fund, 9.4% in our bond unit trust, and 9.9% in our enhanced bond unit trust. Now, talking about our income fund, it's very important for me to explain that although we call it an enhanced income fund, it's not enhanced from a risk perspective. It's enhanced from a credit perspective. So it very much focuses on credit and harnessing that liquidity premium. It's not a diversified income fund. It doesn't hold preference shares. It doesn't hold bonds. There are no bonds in that fund. So it's not exposed to duration risk. It's not exposed to equity risk from preference shares. Nearly all diversified income funds are exposed to that, and some core income funds are exposed to that. So, for example, the Marriott Core Income Fund has a high allocation to bonds. In hindsight, if you want to clear things up, we should have called this the Enhanced Credit Income Fund or the Core Credit Income Fund, because it is quite defensive. And in 2020, when it was the top performing, at one point, top performing income fund because it was so defensive and didn't have equity exposure or bond exposure. And there are some core income funds that do have equity and bond exposure. So it's that whole universe, you need to spend some time digging into what the funds hold, what the managers hold, because it's not that clear. Anyway, from our perspective, what we did is we realized we had a range. We've got cash, money market, we've got credit, which is basically money market but longer term. So just taking on longer term credit and giving you an extra 2.5% or so. And then we had bond funds, which is all the way out here, giving you 9.5% to 10% yields. And those are very attractive yields. They do come with enhanced volatility. So we thought it was important for us to launch a diversified income fund. We're calling it the Income Maximiser. And what it does is it harnesses the best of this universe. So money market, enhanced income, all bond, and enhanced all bond. And invests in the best, the highest yielding vehicle at the time within risk limits. And is very much a systematic approach. So it tries to give you the best of bonds and cash, but in a systematic way. So what we've done is we said, well, let's look at this yield curve. So right now, bonds are giving a better return than credit. Credit has got very different risks to bonds. They're not the same, and they're uncorrelated, and you can put them together quite nicely. So that's what we're doing. And we're blending these two, but in different allocations. So right now, we've got 70% bonds, 30% income, and that's giving you an 8.9% yield, which is fantastic. Yes, a bit more volatility than your standard income fund, and that's why if you look at the fact sheet, we've said a 5-year time horizon. Why it's better for living annuities or people in endowments with a 5-year time horizon. You don't want to invest in it if you've got a 1-year time horizon, because there is some volatility from bonds. Bonds can, in the short term, long term, you will get your money back from bond, but in the short term, there can be some volatility. So if you're only using the yield, this is very important. If you're looking for something that's giving you a maximum yield and you only need to live off that yield, then this is a perfect product, because any volatility that happens to your capital, you're not worried about. As long as you're putting in 100 Rand, you're getting 9 Rand out instead of 6 Rand out, or you're getting extra 3 Rand a year, which is great to spend, and you can afford a bit of volatility. So why not be in this space? This is what we do in all our balance funds. So our balance funds have the same view. If you're in skeleton balanced or signature balanced or skeleton, we're currently overweight bonds, underweight credit. So if you're in any of our balance funds, don't worry, we're already doing this for you. But we also wanted to be able to do this for people who are only looking at income, and that's what we've done. So when the yield curve is steep like it is now, we have more bonds and less credit. But if we ever get back to an environment we had 2 years ago when credit was giving you 10%, so it was up above bonds and bonds were giving you 9%, well, then we'll reverse it and we'll put more into credit and less to bonds. So it is a systematic process. It's not a black box. We use the slope of the yield curve to determine where you want to be to drive the highest yield. And we do think it's was a missing hole in our product range, and we really hope that if this is what you're looking for, that you look more into it, or send us questions, and we can help you invest. It is available on Alchemy, and yeah, it's certainly, if you can afford a little bit more capital volatility, it's a great yield. So let's take advantage of that yield while we can. Now, I do think that we are going to see this environment remain longer than we have in the past. Certainly, every time there's an economic shock, there's deflationary. So inflation from the 2008 US housing crisis, or the 2011 Brexit crisis, the 2015 Chinese shadow debt crisis, the recent COVID crisis. Every time there's been a crisis and markets pull back, you have a deflationary event, and that's what we're seeing in South Africa now. Inflation is sitting well below the target of 4.5%. It's likely to be there for the next while. With the fact that we haven't had a vaccine rollout, it's unlikely that money market rates are going to go up anytime soon. They may go up 0.25%, but we aren't going to see the rates that we used to see in the income, credit, and money market space. 2 years ago, you were getting 10% of credit because real yields were 2% above inflation. Now real yields are negative. In fact, I think real yields are the lowest in South Africa they've been in 15 years. So you can't just sit in cash or sit in income. You need to take advantage of other vehicles. The environment is forcing us to do so, and we think the environment will be like this for a while. We're not going back to the heydays that we had. So take advantage of what we got, which is these high, some of the highest bond yields in the world. If you're in Europe and the US, you don't have this advantage. You're sitting with 10-year yields in Europe that are negative. So they don't have the luxury. They've got negative cash rates, negative bonds. They're pretty much stuffed. At least we do have bond yields that can help us have slightly better income. But coming back down to my first hard truth of the presentation, deflationary environment, high volatility, low returns over the next decade. We need to save more. We need to work longer years, unfortunately. But at the same time, Sygnia is doing all it can to help you mitigate that. And that means that we've got harnessing volatility with tactical, active risk management. We do it in all our balance funds. We're not doing it in income space. We keep costs as low as possible. This fund will be 50 basis points, 50, which is a great fee. So if you're keeping your costs low with some passive, if you're harnessing the volatility that's out there, if you're investing in our diversified growth satellites that are going to see some growth in a low return world, including health innovation, emerging Asia, tech disruptors, that's how you build a portfolio that is robust and deflationary proof. And it's done well for our portfolios over the last through COVID, and we think it will continue to do well for our portfolios over the next decade. So please take advantage of that. Okay, that is a wrap. I see we've got running out of time and lots of questions. Quick question. So yes, living in your the Sygnia Life Income Maximiser Fund. It's focused at living annuities, but we are going to open it up. There has been a lot of demand. We are going to open it up to other life endowment policies, either RAs and endowments. Just please take note of the fact sheet. There's a 5-year time horizon. There will be some capital volatility. So although it's available to all, we can open it up to all those investments. It's not as low risk as an income fund. It is for people who can live off the income, that aren't going to access their capital. The fees are 50 basis points. We unfortunately don't have a tick or TER yet because it is a new product, but those are going to be very, very small. The TERs in the bond space, you're looking at maybe 3 basis points. So we're not expecting anything there. Will it be available on other platforms? That unfortunately will rely on you to get it on the Allan Gray platform. Investors have to petition Allan Gray, so please do. We'd love it to be on other platforms. We think it's a great product. those yields that I quoted are gross. So those are gross yields. So that's on the money market 4.1%, because we've got our zero fee money market campaigns, that stays 4.1. The income will drop from 6.7 to 6.1, and the income maximizer will drop from 8.9 to 8.4. Still 8.5% yield is great. And again, that's what's important. That's the only fee you're paying if you're coming through the Sygnia portal and platform. There's no platform fee. There's no RA fee or endowment wrapper fee. You're only paying the 50 basis points. So it's your cheapest. It's the cheapest way to get into that vehicle. Bruce asks, if you're keen on high risk but don't know much about investments, should I leave my investment where it is now? I'm not sure, Bruce, I'm not sure which investments you're talking about, but certainly we're comfortable that health innovation and FAANG it's good times to be buying right now. There's a question from Ati on healthcare. Certainly, healthcare stocks in general are facing some headwinds as their patents roll off and generics come in. That has always been the case. Healthcare companies are fighting that constantly. So what it requires is constant R&D, so they can get a 5-year patent on a new drug as their old drugs become generics. But all the R&D that's currently being spent on R&D and mRNA will allow a huge number of new patents to be put in place. So we think that is good. Health innovation ETF is not yet up and running. We are waiting for the FSCA to approve. We're looking at end of July, hopefully, for that to be up and running. So another 2 months. Monica asked about our infrastructure bond fund. It's not currently invested available as a standalone. It will be, but right now it's invested in, we're holding those instruments in our enhanced income fund. So we've got some fantastic government guaranteed, this first one, government guaranteed, giving you 2.5% above JIBAR, great yield, great covenants, and so you can access that through our enhanced income unit trust. When we have a diversified portfolio, and that's only as these projects come online, we will then roll that out into a separate portfolio. But right now, we just it's not available as a standalone. The FAANG fund does charge performance fees. Sun asks how long we think the value factor is going to carry on running. The value will continue to run while the US interest rates are rising, and we think that's going to be a 2021 factor only. So we think towards the end of this year, maybe as soon as the end of the third quarter, early fourth quarter, there could be a rotation back into growth. So it's definitely a medium term or a view. It's not a long term view. The question from does the Sygnia All Bond Fund hold the new infrastructure bond? No, that's the Sygnia All Bond Fund only holds the index. It strictly holds the government all bond index. There are some SOEs in that, a tiny amount, but that is an index tracking fund. So the Sygnia All Bond Index Fund is a tracker fund, and that's also currently in the retail space. That's at zero fee. The Sygnia Enhanced Bond Fund invests in some credit, which is how it gets high yield, but that currently is not zero fee. Excellent question from Hassan about fourth IR. Fourth IR has come off a lot, and it is looking very tempting to get back in. We've got a small allocation, so we are slightly overweight, but it's very small. We are waiting a bit longer. We don't think there's anything wrong with nibbling now, but we do think that volatility will continue for the rest of this year. So again, it's that value growth story. While US inflation is peaking, while US interest rates are rising, there's going to be enhanced volatility around tech. There's a good chance fourth IR will end the year up from here, but it might underperform other sectors. So we've got a small allocation to it, and we are waiting for a better time to top that up. Right now, we think FAANG is a better place to top up, but we think it's a great long-term fund. So we don't think if you've got a long-term time horizon, there's no need to sell. There's no need to be concerned about short-term volatility. If, on the other hand, you're waiting to get in, maybe nibble a bit now, but wait for a better opportunity. Certainly these portfolios are long-term investments. It's just like picking active managers. Timing these are very difficult. We do it, we've got a lot of indicators we monitor. We do it in small tranches so that we average in and average out and make sure that we do add value and at low cost. Timing it is difficult. If you do want to invest in a growth satellite for the next decade, then please do so with a long-term time horizon. But if you haven't got in, it might be time to nibble a little bit at 4th hour, and you might get a better entry point. But of course, the world could have, I believe China has a first human case of avian flu. I can't remember the numbers, but we could have another crisis tomorrow. And when that happens, value will underperform growth. All your tech disruptors will FAANG, 4th hour will do phenomenally well, and they could have the reverse. So, we have a plan, we have a roadmap, we follow that, but that can be disrupted at any time. And that's why we do everything in small tranches. And that's why we still have some small exposure to 4th hour in our funds. Mike asked about the limit on the living annuities. So living annuities are now open. You can invest in any of the balanced funds. So any of the funds with 30% offshore are all open. All the domestic funds are open. We still cap the 100% global funds on the living annuities just until we get back below 40. We're very close to 40, but we're keeping those capped a little bit longer to have a bit of headroom on that. But that should be, hopefully we'll have some good news of the next few months. Christopher Gilmore's got a good point on tourism, and I agree. We do need to roll out the vaccines faster to get tourism working. Hassan's got another good question on Africa. So we did actually have an African unit trust. Africa was focused on the equity space. There is some interesting developments in hard currency Africa bonds, and there things are looking interesting. But Africa as a whole, and this is a generalization, is very much linked to commodities. So most African countries, including South Africa, were commodity exporters. So you can get some amazing yields and short-term interest rates throughout Kenya, Ghana, Uganda, Nigeria, great short-term rates. Some of the rates are mid-teens, but you take on currency risk. And A, there's a risk that they can stale their currency, and B, those currencies tend to move with commodities. So if you're bullish on commodities and you're very high risk taking, you could look at Africa. We think Africa right now on the fixed income side and equity side is not right to get in there. And there are places with higher growth, like emerging Asia, with less headwinds that we think are better. The MSCI EM50 ETF is available as a tax-free investment. Sorry, some of these questions are quite long, so just trying to scan through them. So I've got another question on China and the regulatory headwinds. Yes, those are certainly required. There have been some fines, and some of the tech companies are having to roll out. Sorry, I realized I haven't stopped sharing. Some of the like Naspers and Alibaba both having to set up separate subsidiaries where they are going to ring fence all their financial companies, and that has been a short-term headwind to those companies. I think a lot of that is in the price. People are now aware and concerned about regulatory risk from the large cap techs companies. It's also one of the reasons why the new economies China unit trust we have capped some of those tech allocations for the large companies. But I think a lot of that is in the price. and we certainly think that Tencent, Alibaba, and Naspers will recover from these levels. Shahid Peters asks about our Rand outlook. So we have been strong Rand believers for the last year nearly, saying that Rand at 19.5 should be stronger and should sit around 14.5. We got to 14.5, we're now nearly at 13.5. The Rand is very, very momentum driven. Its currencies are the most momentum driven of all asset classes. And when the momentum is strong, they certainly can go through fair. So fair on the Rand, 14.5, maybe 15. But if you go from 14 to 19, we could get down to 13 on the downside. So we've got strong momentum, which is driving us stronger. But we could see some, if negative commodity prices or commodity headwinds take root, that will combat that momentum. So we're in this sort of no man's land where I think we're not going to get down to 11 Rand to the dollar. I think commodity price coming off will prevent us going that extreme. So we might get down to 13 before we weaken. But yeah, I do think end of year we're going to look at a 14.5 Rand, not 11. Wayne asking if we should be buying Bitcoin. I'll ask my team that. When I was at 40,000, I said Bitcoin's getting to 30. Who would buy at 30? And everyone was very keen. Everyone under the age of 40 anyway was very keen. Everyone older than 40 wasn't keen. So maybe Gen X, we're missing out on something, and we haven't done enough research. If it does get down to 30,000, certainly there are a lot of people waiting to get in to buy, and that will support the Bitcoin in the short term. And as long as we don't hold global bonds, and as long as we don't hold gold, there's definitely no reason we put Bitcoin into portfolios, because we class it as the same. And as I mentioned earlier, when it comes to ESG issues and power generation, proof of work coins are going to face more headwinds, which would be an issue for Bitcoin. But Bitcoin has reached the critical mass where it holds its own value just because it exists. So I don't think it's going to disappear, but it has got huge headwinds, particularly on the tax side. And I think with people clamping down on that, we might end up with the only people who are prepared to hold Bitcoin are people who are hijacking pipelines and terrorists who need to launder money, because everyone else who has to register themselves will be forced to use the equivalent government's digital crypto coin. But we'll see if we get there. Believers in Bitcoin think that it'll be free forever. Okay, a lot of comments on my soapbox about ESG and recycling. A question on Naspers and Prosus. So just a share swap that I think, so the Naspers management are doing their best to unlock the discount. Pre-tax, the discount is about 40%. And so Naspers is trading at a 40% discount to Tencent. Post CGT, that's probably about 28%. But still, that's a massive discount, and they're trying their best to unlock that discount. One of the things they're trying to do is they believe that one of the reasons the discount exists is because of the capped SWICs and because investors are buying only 10%. So I don't think this is a big driver, but they clearly do. So what they're trying to do is get around the capped SWICs hurdle and diversify our indices by making it half Prosus, half Naspers, so that there's no artificial lack of demand due to the capped SWICs. So we'll see. I mean, that might help. Part of the announcement is a $5 billion share buyback of Prosus. That'll definitely help. And so I do think that'll unlock some value, but I don't think that's going to unlock the full Naspers discount. But we'll see. Once it's done, if it isn't unlocked, management will have to go back to the drawing board and look for new ways of unlocking that discount. But the share swap story is purely about management trying to unlock that discount. You know, when you've got Naspers making up 23%, 1/5 of the Swix index, with sitting on a 30% discount to Tencent, if you can unlock that in one go, you know, you're looking at a 5% bounce to your index overnight. I mean, that'd be wonderful for every retirement fund and every investor out there. So we're holding on for that, but you know, it might take a lot longer for it to happen. And that is all our questions. So thank you everybody for signing in. I hope you have a fantastic June. Good luck with level 2 lockdown. Stay safe. Good luck with stage 2 load shedding. I hope that you can survive, and good luck for our cold winter that's coming up. And I'll see you all in July. Thank you.